We've been dealing with this China trade dispute as a front and center issue for almost a year, really. Over that time, we first thought the U.S. economy might be overheating. Now we're worried about it slowing down. The global economy's changed its complexion too. How much of a swing factor do you think a potential agreement or continued friction with China is for the markets?
Well, I think the markets China is a huge swing factor for the markets right now. If you look at the way earnings are being digested by the markets, as we started to see companies that were releasing information about China exposure, those are the companies that are seeing the biggest drawdown in pricing and the biggest misses. So those are the real concerns that I think that the companies have, is exposure to China and exposure to the growing concerns around the cyclical exposure to the economy that is clearly slowing.
And do you think that some kind of an agreement would release that pressure very quickly, or is it just, the China economy has to find its footing otherwise?
Yeah, we do. We think that actually right now investors are very, very light on risk. We see that in mutual fund flows. We see that in the beta exposures in mutual funds generally and institutional portfolios. So light on risk right now, and any upside surprise, whether it's trade, whether it's the European turmoil, going to have a relief rally that are going to catch investors off the sides if they're not involved in that.
Krishna, you think the U.S. is going to be fine, but the rest of the world can come back a little more strongly?
Well, so I think we have to be careful. We can't conflate two separate issues. One is the fact that Chinese economy is slowing down. And the second is the trade. They're related, but they're not the same issues, and I think that's important. I think as far as the Chinese economy is concerned, they're already starting to stimulate the economy, and our expectation is they're going to throw in the kitchen sink before this is all over. As far as the trade deal is concerned, I think one of the reasons why we didn't arrive at a trade deal in 2018 was because the U.S. economy was doing much better. As the economies everywhere continue to slow down, the pressures to reach some sort of a deal increases. And therefore, I think the markets are going through a relief rally of sorts. And I think the outlook for emerging markets is very good, because I think policy would be supportive, growth is going to come back, and we will reach some sort of a trade deal.
Krishna, when I talk to investors, portfolio managers, on and off the air, here's the number one thing I hear on the U.S.-China trade front. We're not afraid that Trump's not going to make a deal because he's afraid of the stock market falling too much. Is that something you can bank on as an investor?
I don't think it's the stock market per se, but I think the economy for sure. I think if the economy continues to slow down, finding some sort of a resolution going into a re-election season, I think is important politically, and it's really good economic policy. To some extent, we have to remember, there are different opportunities and times to arrive at solutions to long-term problems. Trying to force a solution in a very narrow window is not good policy, and I think there are enough people in Washington who know that.
Maddi, we've got a Fed meeting today. No one's expecting much of anything. Is there something you're watching for, something unexpected perhaps that is an actual risk?
So we're not expecting anything unexpected, right? We expect the Fed not to increase interest rates today. Right. I think the key thing we're watching for is the rhetoric and the guidance, the forward guidance. Remember, we're going to get a monthly press conference now, so over communication from the Fed, which I think communication is a good thing. Of course, it depends on who's doing the talking, but we do expect that
we know who's doing the talking.
Yeah.
Sometimes his talking
hasn't worked out.
Yeah.
Exactly. So we're looking for words around patience. We're looking for more dovish rhetoric. Same kind of thing that we've seen out of the ECB and the BOJ over the last couple of weeks. So we're just looking for the Fed to be consistent in that synchronized approach around global central banking on dovish rhetoric.
More broadly, Krishna, if we remove a lot of these kind of uncertainties everyone's fixated on, right? Whether it is the trade deal or the slowdown, if we get reassurance that growth is okay right here, companies are back, on firmer footing, does that bring us right back to the point that, hey, by the way, the Fed still thinks they can get 2 hikes in this year?
Well, so I think that is certainly a risk. I think if the markets rally too much, that gives the Fed the free pass that they are actually looking for, because I think they're still the believers in the Phillips curve. Mm-hmm. Having said that, I don't think, given all the slowdown in the economy, we will probably get the gangbuster rally that we need for the Fed to kind of get ahead of. Bottom line is...
So that puts a ceiling perhaps somewhere on the market, but it's where exactly?
Well, so I think if we, let's say, end of February, we are 10, 12% for the year, that probably is too much, and that brings Fed back into the play. The bottom line with respect to 2019 from our perspective is two things. One, 5 more years. This growth will continue at a subdued level, but for a reasonably long period of time, one. And second, the reasonable growth in 2019 with better policy, whether that is on trade front or whether that is on monetary policy front, gets us better outcomes.